Okay, good afternoon, everybody. Most of you guys I have the pleasure of knowing, but just in case we've never met, my name is Aaron Wilson, also known as Uncle Aaron, and I am the CEO of My Mortgage Trainer. It is always my sincere pleasure to have the opportunity to bring you guys some great information. When we do these, we do a lot of free webinar series. We try to do one a month where we, can bring you some new information that might be able to help you in your career. Today, we're going to be talking about non-QM mortgages. And again, this is a free webinar. Let me do a shameless plug real quick because, I have that right, We'll say that this event is sponsored by My Channel Plus, which is actually a product that we have, you guys. What we do with that is we just help MLOs develop, manage, deliver custom content for, a steady stream of long-term business. It's not advertising, it's content marketing. So if you're working the content angle in a market like this, good for you. If you're not, you better get started. You better get a lot of lines in the water, make sure you're baiting all those hooks. You need some help with that, feel free to reach out to me separately. My email is aaron@mymortgagetrainer.com, and we can arrange a time for you and I to discuss that on a private Zoom. But all right, let's get on with the show. Now, as much as I would love to tell you, Thomas, that I am a straight up ninja when it comes to knowing everything there is to do with every type of loan product out there, or every strategy out there, just let me just say that sadly, I am not the ninja that you think I am, which means that sometimes I have to rely on other people who are more versed in these types of topics. So that means basically I get to learn right alongside you, right? So today, what I did is I invited in a special guest expert who is actually, believe it or not, she's actually one of our students too. And we did this to introduce you to the different types of non-QM loan products that currently exist in the marketplace, you guys, and also to just have a quick open discussion near the end of this short webinar to explain, where you guys might find opportunities for these types of loans, and then how would you submit them? And some of you guys might already have the avenue to submit them, and may not know that, or maybe just didn't know how to do it. But regardless, today's special guest is the lovely Holly St. Germain from Angel Oak Home Loans. She is, I hope I got this right, Holly, a sales development specialist, if I'm not mistaken, in the portfolio lending department.
That is correct.
All right, look at me. Check out the big brain on Uncle Aaron. All right, so Holly, two questions. How you doing today? Number one, and number two, what do you got for everybody? Because I'm turning it over to you and I'm going to spotlight you at this point. So I will shut up. All right.
Awesome. Thank you for the introduction. And I'm doing wonderful. I'm in sunny California, so away from the hurricane, which is nice. So a little bit of heat wave out here. So I'm waiting for the fall temperatures to actually kick in, hopefully in the next week or two. And yes, my job title is Sales Development Specialist for the non-QM products for the retail division of Angel Oak Home Loans. I'm also originator. I've been in the business for 20 years, so I still originate on my own, but also am the key resource for our company when loan officers, especially new ones, that are not aware of how to originate non-QM products and deliver that product knowledge to. Is the fear with our loan officers is that they are aware of the product and program, but they don't know how to sell it, or they think it's too difficult to explain to a borrower. And in truth, it really isn't. They're actually probably a little easier than your traditional agency with Fannie and Freddie, because there's so many different guidelines and overlays that pertain to those programs. So most of the time, the non-QM avenue is pretty cut and dry. And yes, there are opportunities for exceptions, and we do a lot of those. Probably about 20% of our business and loan officers submit for exceptions, because the unique feature of Angel Oak Home Loans is that we have a capital funds market that we sell these loans directly to. So we know what their appetite is. We don't broker them out to anybody else. We actually fund the loan and sell it to those investors in-house. So pretty unique.
Nice.
I want to highlight, there's definitely two top programs that are very common in the marketplace that most LOs will sell to their borrowers. And that's the bank statement loan program, and then the investor cash flow loan program. So I want to talk a little bit about those two programs. So the bank statement program, let's go back to the target customer. The customer that you're looking for is somebody that is self-employed, typically independent contractor, gig worker, maybe a client that doesn't fit into the agency box, but is a W-2 employee as well. Maybe they have some credit challenges that exceed the waiting periods that are traditional on the agency side. But for the bank statement program and investor cash flow, you are looking and that is going to allow them to purchase a home without using their traditional tax returns, because they're taking their right to write off certain items on their tax return, so it's not going to cash flow. So there's nothing wrong with their tax returns, it just doesn't fit into the vanilla box of agency. So they do have income, they are qualified, they're just underserved borrowers out there in the community that don't know what's available to them. So it's our opportunity to educate and find those borrowers and say, you know what, we do have an avenue for you. And we use the business bank statements, or we can use personal bank statements. And they can be 12 months, 24 months of qualifying off of the deposits that are in those bank statements. So one really nice thing is you're not pigeonholed. So say if you submit for a business bank statement loan program and you do the income and that doesn't work, maybe you try the personal bank statements, because there could be income coming in there that's going to be higher than the business bank statement eligible income. So we can toggle between the two. So you're always better off maybe looking at both to see what's going to give you the most income to qualify. And those deposits are 100, you take a percentage of what the expense ratio is based on the business. And the expense ratio is typically what are the operating expenses. So some business will have a higher percentage. So if you have a brick and mortar business, a flower shop that carries, their inventory, and they have payroll and they have delivery trucks, that's going to be a higher percentage, and that's about 70%. So you'll be able to use 30% of the deposits for qualifying income. Now, if you have a realtor, which has no inventory, is usually the minimum. But if you're able to get a CPA letter to indicate that their expense ratio is less, then we can go down to almost 15% expense ratio on that type of business, because they don't really have that much in operating expenses. So you have more income to utilize. So there's so much room to kind of figure out where does your borrower fit in and give them more income without using traditional tax returns.
I want to stop you for a second and just ask you a question. I think a lot of times when I talk to people about non-QM loans and they talk about bank statement or using their cash flow from either personal or business bank statement, the perception is that it's going to be a commercial based loan. Can you comment on that? I mean, are these loans going to be commercial based, or are they going to be, for example, your real estate agent who's trying to refinance maybe your existing home or buy a new home under this program?
Okay, so we are restricted to the residential rules of 1 to 4 unit properties. So they do need to fit into the residential use of that house. Depending on the number of units, especially out here, you have accessory dwelling units. So those are all permissible as well. We also allow for non-warrantable condos, which usually throws people out, especially if they exceed the investor concentration on the condo unit. We go up to 100% investor concentration, so that's huge. We also, only on new construction, we want at least 10% of the project completed in order for us to provide financing on that. So we're a great avenue for those borrowers, clients, and traditional agency box.
And I may have missteered you there. I just kind of,
Okay.
the other thing too, actually, I'm glad you said what you said because it was all information. So I just let it roll. But meaning like, does the, if I were the borrower and I own a business, right? Just because you're using my business tax returns based on a percentage of that I own, I'm not
Right.
closing this loan as a business loan. I'm closing this loan as a residential. I'm the person going on the loan application, correct?
Correct. And then thanks you for clarifying. Correct. So the individual will always be the borrower. And we do have an opportunity to vest in an LLC. But always the borrower has to be an individual, but the vesting could be a different option. We could do that in trust. We can do that in the business name. Most companies that I have worked for in the past, they don't allow vesting in the LLC. You typically would have to advise a client to vest it in the individual name and then deed it back, which opens up for a lot of liability if something should happen, if that doesn't get completed in a timely manner.
And then I don't want to get ahead. You probably already have this planned out, but I remember when the original subprime market came out years and years ago, prior to the crash, these are the loan products that actually made the most sense. And I've always said, I've always been a big proponent ever since even after the crash that, they never should have taken away the self-employed bank statement income loan, as long as the pricing was right and the LTV was appropriate, and we verified cash flow and verified that that person was legitimately in business. Can you speak to what the LTVs would look like for somebody? Let's say that because some of these people on here are newer to the industry, so they might be wondering, okay, well, certainly I could go out, and I know you're going to give some examples of people I could go talk to maybe locate these types of clients. And but if I found somebody that was a self-employed borrower that had good cash flow, but happens to be writing his Porsche and everything else off through his business, right? Then how do I what kind of LTVs are we looking at for that type of borrower if we were looking to refinance?
And it's a great question. And Angel Oak, actually, during the crash in that time period, that's kind of where we grew the most, because we were already offering those type of loans, but we were doing it with guidelines and restrictions to ensure that the borrower was able to repay. So we have a great rating out there in the industry, because we know how to look for those things that may have been faulty in the past. So I'm proud to say that, because they shouldn't have gone away. There's always a borrower that truly qualifies, as long as you can document where that source of income is coming from with that. And so go back to sorry, I lost my thought there.
Well, LTV, just like
LTV.
Yeah.
Sorry. Yeah. So right now, with how the market was, and I'm sure everybody's getting pounded with adjustments in their pricing and rates over the past couple of weeks, and so have we. So the appetite out in the secondary market is definitely going to be a little bit more restricted. So for us, and there are other companies that offer the programs, we right now are kind of restricted to an 80% LTV, but when they open back up, we have gone up to 95% in LTV for they have and what their reserves will be as well. But we have gone in the past, prior to all these nice little changes going on with the market, up to 95%.
That's awesome. And then obviously, these are not the typical, those that have been around a while in the business and saw the 2008 debacle. These are different types of loans. I mean, we're not talking about people who have, poor credit, these are people, this goes back to the original idea of lending standards that made sense for these types of borrowers. They were lower loan to values. There are higher loan to values obviously available in this scenario, but these are people that showed cash flow and showed responsibility in paying their debts and had good credit. So we're not talking about the, hey, let's give somebody that's got no credit score whatsoever, 95% loan to value loan, and then, hope that this thing sticks. So, well, what other products do you have out there in the marketplace for the non-QM product?
So our next product is called the investor cash flow. And this one is definitely a huge product for everybody that has those borrowers that are true investors. And maybe they have multiple properties and they're restricted on the agency. We don't have a limit to the number of properties somebody's owned, and we also don't require any income or employment information. The borrowers qualify off of the market rent that comes off of the 1007 as part of the appraisal. So once we get that market rent value and the proposed payment, just say is 4,000. We want to see that 1-to-1 ratio to cover to make sure that makes sense. So we have gone down where there are products that have a what's called a debt service credit ratio and then no DSCR, which you wouldn't have to have any ratio whatsoever. So market rent could be lower than what the payment is, and you would still be able to get a loan. That has kind of been a little bit more restrictive in this market, but it will come back. And that just allows the investors to not have to provide all of their documentation, especially if they own multiple properties, in order to qualify, because they just qualify off of the subject property market rent, which is huge.
And can these investors, assume they could have like apartments or single family residences that they have signed leases with, but what about like short-term type lease scenarios like an Airbnb or a VRBO?
Yep. So we offer both, whether it be a single family residence or condos, because we definitely are, on the East Coast, there's a lot of condo complexes, especially in Florida and the Carolinas, that are in communities that have that short-term rental component, and we do allow for short-term rentals as well. So if it's a refinance and you want to use the market rent, you can still have the opportunity to do that and use that market rent. But if, say, your lease agreement is higher than the market rent, then we will use your lease agreement at 75% to give you that opportunity with that higher number. So you can both do single family, Airbnb, VRBO, again, and those are those individuals that are, you're not using those tax returns, you're not using the Schedule E to qualify, you're utilizing the rental income existing with the borrower.
I noticed too, when I was looking at guidelines, you and I kind of did some emailing back and forth before we started talking about doing this event. And there was something I kind of noticed on the actual term of the loan. Can you comment on that?
So our available terms are 30-year fixed. And then a very common feature is the interest only. So we will do a 40-year term with a 10-year interest only. So you're not going to qualify off the interest only, which is standard and typical, but you will qualify off the amortization for the remainder of the term. So the interest only just kind of, it's very attractive for payment, cash flow for the borrower. And then usually in that 10-year period, the market's going to change. So they're either going to sell the property, refinance, and give them the opportunity to refinance in the lower rate environment, hopefully, which should happen in a 10-year period if the cycle goes the same.
Right. And to be clear, that the interest only option was on the first 10 years of the loan.
That is correct.
And then it goes to a fully amortized loan from there over the next 30 years.
That is correct.
Awesome. Anything else that anybody should know about that, or should we just move on to the next product that you have? Your call.
I think, yeah, I want to highlight some things that people don't necessarily think of as non-QM, and that, turn my light back on.
And there are a couple of questions that have come in directly to me too, that I can ask you, but I guess, do you want me to ask those now, or do you want to go back to the questions later? I'm game for either one. So,
Oh, we can answer some questions now.
well, Lauren had just asked on the interest only product. Is this on all products, or is this only on the DSCR, investor cash flow loan?
No, we do offer that option on all of our products.
Okay. And then there was a question too about how to calculate the income on the VRBO, but I assume, obviously VRBO and Airbnb have, reports that they provide. That's a good question, I guess.
So
Yeah, go ahead.
so we wouldn't actually use the VRBO income statement that's generated. We're going to use the appraisal and that 1007 value that comes in qualify.
Okay, makes more sense.
Unless you have a specific lease agreement. So if it's a refinance and you have that tenant and you have a lease agreement on that individual unit or single family home that's being utilized as a VRBO, then we will look at that lease agreement. But you're not providing any statements from your VRBO printout.
All right. So do you want to make any other comments about that particular? You said I kind of derailed you. You were like, nah, I wanted to make a couple more comments about this. I'm like, hey, wait a minute, we got some questions,
No, the questions are good. So when I first started non-QM, I didn't think about these two items being part of non-QM. Most of the time you think of maybe FHA because they have some different credit guidelines, but the two items that fall under non-QM for us as well is the foreign national borrower, as well as the borrower that has an ITIN number. So we do allow both of those borrowers. The foreign national or work in the United States, they need to have their home country, have a residence, own a property, and have employment there. And we do not pull credit on that. On the I-10 borrower, it's going to be a full doc loan. They need to file their tax returns using their I-10 number. We do not want them to have a social or any eligible green card or permanent resident card as well. So most of the time people think, oh, okay, they have an I-10 borrower and they didn't know where to take that borrower because they don't have a social and can't pull credit. So that's two things that are helpful to keep in mind, because sometimes you're not thinking about it, but you may have an agent that has some borrowers, especially out of the country, that are looking to invest in property in the US. So it's a huge opportunity to do that. And then the other one that I use quite often here in California, you'll have a lot of borrowers that may not have employment or income, but they have significant assets. Maybe they receive income from a trust fund and they have high balances. And I'm talking like a couple $1 million sitting in a checking account, savings account, investment account. We can utilize those assets without liquidating those and turn those into income to qualify. So that's another one that kind of is very helpful. And all these programs as well, especially where the market has been, and then with the higher interest rate environment, usually brings out some more cash buyers that the buyer can utilize their own and then do delayed financing with these programs after. So what that means is they go in, make their offer, purchase cash, but they want to recoup some of their funds to replenish the assets so they can go do other things with that. And that's called delayed financing. And we can put a loan on within 6 months of purchasing the home as cash on all of the programs that we have for non-QM.
That is an interesting little twist.
It is. It definitely worked during COVID.
I'll bet. It did. Wow. So you had, I believe you had one other loan product too we wanted to talk about, right? And then can we kind of switch gears a little bit and talk about maybe like independently where we can maybe go find some business in these areas? Because everybody right now is interested in, okay, what's out there, that I'm not doing. And then, where can I put some more lines in the water, to catch some more borrowers. I don't want to call my borrowers fish, but there you go.
Yeah.
Also, there was one more question on the I-10 product, the Foreign National, and the question on that one was LTV, and
So that is at 75% right now.
Okay.
So, which is typically those type of buyers are looking to put at least 25. Some of them think they have to put 30 or 40% down. So 75 is pretty aggressive for not having to document any employment or income. I also want to share for us on the non-QM side, when you look at alternative programs and then you look at jumbo financing and you look at the investors that you currently have up, is the amount of reserves that are required to qualify. So the reserves meaning the amount of money that you have on hand after you've done your down payment and closing costs, what you have left. Normally you need 6, 12, 18, 24 months, 36 months on some of the jumbos. Our reserve requirement is 6 months on the subject property only. That's crazy. So you can have other REOs and we don't need reserves on those other properties that you have.
Somebody's figured out that those loans still perform.
Mm-hmm. And our performance level is just as high as if it was any type of government and agency loans. So we've had no poor performance on our loans.
I'm not surprised. I mean, again, a lot of the people that you guys are dealing with are people who have cash flow, but not really, have the ability to show all the income. And these are people that are used to leveraging, right?
Yeah.
I mean, that's the name of the game. I mean, all of the people that, the big speakers or motivational people that you'll see surrounding the real estate market, that, it's all about that leveraging things to build wealth. And
Mm-hmm.
so we're used to these types of things. So it's great to have this type of program, because for a moment, this didn't really exist. So
right.
It's not what's that.
And that's kind of timely and a great segue on where can you find these borrowers. So my suggestion first is, just find out what type of resource you have for non-QM and market that. That's the biggest door that will open for you. Real estate type of program is not what everybody else is doing. So to just call somebody and say, hey, can I come in and, share some information with your team? And it's the same old, we do sell direct, we have, Fannie and Freddie. This is something that they want to hear, because these are the challenges that agents are having. They have these borrowers, they just don't know where to go and what's available for them. So I would always start with the agents that you have, and setting new appointments with agents that you've never been able to get in front of, and just say, I have something new that I want to share with you that will allow you more opportunity to grow your business and achieve more income, because we can focus on a different borrower description. So that's number one. Number two, accountants, CPAs, these are individuals that see people's tax returns. They know exactly what's going on and what's needed. So if you have anybody in your sphere or somebody that you've wanted to sit in front of, use this product to get in front of them, because they have clients and they need financing, because maybe they need that for their tax write-off. And who best to know that than their own CPA and accountant? So, and then you work in tandem with them, because you want to inform them of what you're doing as a mortgage planner, to incorporate and achieve their overall financial goal for the client. So you'll get more referrals back because now you just mentioned something to a CPA who speaks to other people in their profession to get more referral sources for you. And then the other one would definitely be financial advisors, because the financial advisors refer to the CPAs back and forth, and then you kind of just grow, set yourself apart.
You know, and that's good information, because honestly, if you take a look at the typical MLO and, you know, their approach to going out and establishing relationships with referral partners, they're really going to be chasing down the real estate agents, right?
Yep.
And when you look at a market right now where you've got more licensed real estate agents than you do homes available for sale in the marketplace, they're tired of MLOs walking in there. And unless you had something that, again, is some new product or something like that, or free candy, you know, you're going to need some type of, you know, something. You're gonna need something. But what's cool is, you know, this opens up a whole new opportunity for you to go out and talk to financial advisors,
Mm-hmm.
and go out and talk to CPAs that maybe aren't so used to being, you know, someone stopping in and wanting to know if they'd like to maybe go out and have lunch and talk about this new and exciting program that I have available, because they do have borrowers that are in need. And that gives them an opportunity. You guys, here's the one thing that I always like to say, you know, with all of these types of things, each person that you go out and try to establish a relationship with, a referral relationship with, what you're trying to do is establish more value for that person.
Yep.
Because the reality of it is if it's just a CPA and that's all he does, he crunches numbers, and you see him once a quarter or once a year to pick up your taxes, you can go, dang, I owe what? You know, then, you know, that's not really the type of relationship that anybody should be building. I mean, each one of us should be in a situation where we are building long-term relationships with our clients. Otherwise, we're just a commodity, and somebody's just going to go down the road when they find somebody else cheaper. So you give that CPA, you give that financial advisor another opportunity to make a valuable contact where they're not saying, hey, I'd like to refile taxes for you again. Or, I mean, obviously that would be, you know, something silly, but I mean, or, hey, have you thought about investing in this? Right. As from a financial planner standpoint. Instead, now they've got another way to lead in and talk to a borrower about something new that, you know, that they can make an introduction to. So, I mean, it's still any thunder there. I don't even know if I did, but the reality of it is, I mean, I like the idea that it gives me a couple other avenues to go talk to. And that's what I need in this market right now.
Right. And it's all about, you know, what can you do for me, right? What is that value that you're going to provide to me that I can now provide to my clients? And my suggestion, if you've never spoke to a financial advisor, but you have a client, start with a client that you're really comfortable with and ask them, you know, who files your taxes? Call that person up and introduce yourself, saying, you know what, I'm working with so-and-so. It's a mutual client. I just want to, you know, let you know what my thoughts are, what my strategy is for the client. Does that fit within, you know, what you're working with them on together? And they probably have never received a phone call from a lender introducing themselves, saying, I'm working with your client. And then that's just going to grow a little bit more trust. And then they're going to be intrigued, like, okay, what else can we do? Like, I have other borrowers just like this one that you may be able to help assist with. So it really just start with one phone call, and it will go a long way. It will pay dividends for you.
So can we move on to, and thank you for that, because that's, you know, I'm never really the kind of guy that wants to give you a piece of information and not kind of figure out how we can tie that in and be something valuable to you, you know, I mean, but now that leads me to the next question that should be on everybody else's mind right now too. And if it's not, then where are you at? Question. Because there are people on here that maybe already have a relationship with Angel Oak, right? Their company does. They're either a mortgage broker company on here, they work for a mortgage lender on here, and they already have a correspondent relationship with Angel Oak. But there might be some people on here right now that are going, this sounds really cool, you know, but how's this work? Do I just refer the deal over to Holly, or I mean, how do I get paid on this deal? Because same thing, like you just said, what's in it for me? I'd
Sure.
love to be able to originate loans someone else can't do, but I also still have one goal in mind. And that is to continue to fill my own personal bank account so that my kids don't have to share plates of food. I'm just saying. So how do we do this? I know I asked you a lot. I'll put it back on you.
Yep, no, that's great. And I'm so thankful to be, part of this and just sharing information. That's one of the things I love to do, is just educate. It just empowers everybody in our industry to be more educated, to get the word out. So I thank you for the opportunity. So for me, on the retail side, Angel Oak Home Loans has a consumer direct division, right? A call center. They also have their wholesale division, which is where most of the companies that are independent mortgage bankers or brokers will sell their loan, work with through that channel. And you're going to have an account executive that you work with to help structure loans and send the loans to and get them in the pipeline. If you don't know who your account executive is and you are already working with Angel Oak, just reach out to me. I will put you in contact with the right individual to make sure that you get the information and the process of what to do with the loans going forward. If you are no interest, or your company doesn't have any interest in signing up with Angel Oak, but at least you're referring it to somebody that you now know and trust, that knows what they're doing and will actually, give you credibility, because when you hand out a referral, that's your reputation on the line, and I take that very seriously. So I want to be a good reflection for you and your clients, that you refer them to a good source. So whatever you need, if you need to just be realigned or get introduced to getting set up with Angel Oak on the wholesale side, just reach out to me and I'll get you in touch with the right person.
And is there, I mean, I'm throwing it out there, but is there anybody on here right now that, you can hit me on the chat log or what have you? I mean, is there anybody on here right now that, like, I don't know if my company's approved or has that channel, or for a fact that you don't currently have that channel? I'm just curious, because if that's you and that's your organization, again, what you're going to want to do is reach out to Holly, and she can connect you in whatever way needs to happen here with appropriate account manager or channel, so that you guys have access to these products. And I'm sure on top of that, Holly's got some additional, probably product-based, or the account manager will, of course, as well, product-based matrices, if you will, to be able to. Is that what we still call them? Do we still call them matrices?
Yeah, they do call them matrices.
I didn't know if I just dated the hell out of myself or what.
That hasn't changed.
You just never know, man. You never know. Listen, I had a conversation the other day with a guy, and he was telling me that he went and played golf at this one particular place. And I said, oh, I said, hey, this person, I'm pretty sure this person owns that. And he goes, who's that? And I go, he used to be like the backup quarterback to the Colts. He's like, when? I go, I don't know, like 98. You know what he said to me, Holly? I was born in 98. I was like, oh, wow.
Yeah.
Gotta go.
I have no idea what you're talking about.
So I have those moments.
No, they're still called matrices. And I also want to throw out, for loan officers, if you're looking, to make a change, I know that the market's, very uncertain and everybody's kind of, hunkering down. But if you're just are interested or thinking about maybe making a change because you want a company that offers everything in-house, traditional and non-QM, please reach out to me. Just as, just a conversation. So if you want to get more educated on what we do and how we work and who we are, please reach out.
All right. So does anybody have any questions that you would like to ask? I'd be more than happy to open up your microphone. If you'll hit me in the chat log and just say me, I can open up your microphone to allow you the opportunity to ask that question. Don't be shy. This is the place to get that question answered if you have one.
Yeah.
Now, sometimes what happens, Holly, is, we do such a bang up job. It's like people are like, what could I possibly ask? You guys covered it all, So at least that's what I like to think, you guys, when you don't ask questions, that like we did such a dang good job that you're like,
Genius.
what else could I ask? So again, so if you have any questions, put it in there. If not, then here's what we're going to do. Holly, what is the best way? I mean, obviously you could just go right here. What is the best way for them to get a hold of you? And by the way, we did get a question, but instead it came in over the chat log.
I'm gonna put my email address and cell phone number in the chat.
Make sure it goes to everyone.
I am.
Tab, yep. And then Kent, I'll ask that question for you in just a second here. We'll let Holly put that in the details here. All right, good. So Holly's information is in the chat log there. And then I'll post that down when we put it into the when we put this recording into the Facebook group or into the channel. I'll put that contact information into the description of the video. Kent says, he has a question. He said, are there different credit requirements for qualified mortgage versus non-qualified mortgage loans?
100%. So and on top of just being QM versus non-QM, you're going to have your agency, and then you're going to have your own company's overlays if they have that. So everything is so specific to who you are working with or who the investor is. What I can talk about on credit requirements on non-QM, they're definitely going to be less restrictive. So when you're, for instance, waiting periods for foreclosures, bankruptcies, short sales, you have your 2, 4, and 7 years typically on agency, whether it be FHA or VA and conventional loans. And then non-QM, we can go as low as, again, it's going to be depending on what bucket and what product and program, but we can do 1 year out of foreclosure, 2 years on BK. So they're definitely less restrictive. So when you have the borrowers that are just outside of those, I call it just misses in the agency side, that's when you can pivot to the non-QM, because you do have an opportunity to help that borrower still.
All right. Any other questions that you guys have? If not, I'll give you just a second here. All right. So, well, then what I would like to do then at this point in time, if there aren't any other questions, because I'm sure if they have any questions, they can also email you, since we're going to put that contact information in there. Again, it's holly.stgermain@angeloakhomeloans.com. If you have any questions, you can email Holly to get answers to those questions. She can connect you with the proper channel if that's what it is for your organization, if you're not already signed up to be able to offer these types of loans. But Holly, thank you so much for coming out today and taking time away from your own origination, time that you should be spending doing that, to share your knowledge with other MLOs that maybe, could use another product line in their mix. Because like we said earlier, right now it's about all of us getting as many possible baited lines out into the waters that we can, so that we can just survive this, what I would call a little bit of a storm. I don't think anybody's going to argue that we're in a storm right now. This storm's not going to last forever. This is not 2008. We do not have crappy mortgage products out there. We have a very strong mortgage portfolio. The Fed is pumping the brakes for a minute. We're going to experience a little bit of a tightening, if you will, but this is not going to be a long-term scenario. And what I like to, it feels like to me, Holly, like the pulling of a rubber band.
Yeah.
Right? Like what? Like
analogy.
The Fed is pulling that rubber band right now and holding on as tight as they can to try to fight that inflation. But at some point in time, when they have to finally admit the R word, what do they got to do with the rubber band?
Yeah.
They're going to have to let it go.
A slingshot.
Yeah. And then you guys are going to see rates go right back down again. Now, I think we're going to see 2%, probably not. I would venture to say we're, let me hold on. Let me get my this is not a crystal ball, it's my microphone, but it looks like a crystal ball. I'm going to go with 4.5, and I'm going to give it 9 months. Ooh, that's a prediction to put on to a recorded
Yeah,
video.
that's right.
Shot myself in the foot, but we'll see what happens. We're just going to will it. That's what we're going to do. All right, guys, listen, appreciate all of you. Have a fantastic day. Again, I will post this on the Facebook group. Holly, cannot thank you enough.
Thank you. Thanks everybody for attending.
Ooh, all right, everybody. Have a great rest of your day. Take care.